Today, we're looking into one of the best ways to earn passive income without dealing with tenants, property maintenance, or hefty down payments. We are talking about REITs, Real Estate Investment Trust. If you're looking to get into real estate without the hassle, this is the perfect video for you. So let's get into how REITs work, the different types of REITs, and how you can invest to build a steady income stream. And yes, I have some of the best REITs out there to share with you along the way. First off, what exactly is a REIT? Think of a REIT as a company that owns, manages, or finances real estate that produces income. The beauty of REITs is that they are required by law to pay out at least 90% of their taxable income to shareholders. So instead of buying a property and dealing with all of the headaches, you can buy shares in a REIT and receive a regular stream of dividend. Now, there are three main types of REITs, and each one has a different approach to generating income. First, we have equity REITs. These REITs actually own and manage physical properties like office buildings and shopping malls. They make their money primarily through rental income from leasing these spaces. If you're looking for steady, reliable stream of dividend, equity REITs are the way to go. Plus, you can also benefit from the potential appreciation of the properties they own. One of my favorite is Realty Income Corp. Realty Income is the largest triple net retail REIT in the US, specializing in single-tenant properties where tenants cover all expenses, including taxes, maintenance, and insurance. It has a 5.1% dividend yield and pays out monthly. The company has strong performance and stable tenants, making its dividend highly reliable. Realty Income has a fair value estimate of $75 and closed at $63.31 on October 24th. Another great equity REIT is Invitation Home Inc., INVH. Invitation Homes owns and leases single-family homes across the western US and the southeast, focusing on starter and mover properties. In many of these markets, renting is cheaper than owning, which drive high occupancy rates and rent growth. The company also manages costs effectively by using in-house maintenance staff, which results in higher margins than its smaller competitors. It has a forward dividend yield of 3.3% and a potential upside of 19.3%. INVH has a $41 fair value estimate and closed at $34.32 on October 24th. Then there is Park Hotels and Resorts Inc., PK. PK is a REIT focused on its high-quality portfolio in popular U.S. getaway markets. It spun off from Hilton Worldwide in 2017. Recent property renovation will likely drive strong revenue per available room and result in robust revenue growth. The stock offers a forward dividend yield of 7.1% and a potential upside of a whopping 77.3%. It has a fair value estimate of $25 and closed at $13.97 on October 24th. The next type of REITs are mortgage REITs. These REITs don't actually own properties. Instead, they invest in real estate loans and mortgages. Their income comes from the interest on these loans. The upside? They often offer higher dividend yields because of the interest income. But be careful, MREITs can be more volatile and sensitive to interest rate changes, which could impact their returns. I'll have a great MREIT for you shortly, so keep watching. And finally, we have hybrid REITs, which, as the name suggests, are a combination of both equity and mortgage REITs. Okay, so how do you actually invest in REITs? It's super simple. Here are the main ways to get started. The first option is to buy shares of publicly traded REITs. You can do this through any brokerage account, just like you would with stocks. Another option is non-traded REITs, which aren't listed on public exchanges. We can address these in a subsequent video. You can also invest in REITs mutual funds or ETFs, exchange-traded funds. These funds pool money from multiple investors to buy shares in multiple REITs, which give you diversification across different types of real estate. Plus, they are professionally managed, so you get the hands-off experience while still tapping into the real estate market. Buying and holding REIT ETFs rather than individual REITs can be very beneficial. This provides investors with a level of diversification that would be difficult, if not impossible, to achieve otherwise. Furthermore, most REITs are managed by experts in the commercial real estate industry or are based on popular broad-based REIT indexes. The professional management REIT ETFs offer is very valuable, especially if you do not have time to research the large universe of REITs on the market. Here are 3 of the best REIT ETFs out there. Schwab US REIT ETF, SCHH. This is a solid REIT ETF with $7.3 billion in assets. It offers a straightforward approach to real estate investing with a low expense ratio of just 0.07%. It has a forward dividend yield of 2.43% and pays out quarterly. SCHH's largest holding is Prologic Inc., PLD, which accounts for about 9% of the fund's assets. But with 119 total holdings, it avoids concentration risk. This REIT ETF is an excellent core real estate holding if you are seeking lower costs and potentially higher returns compared to more expensive REIT funds. Another great REIT is the Fidelity MSCI Real Estate Index ETF, FREL. With a low expense ratio of a meager 0.08% and a 12-month yield of 3.4%, FREL is a cost-effective ETF managed by the well-regarded Fidelity Investments. The ETF has assets of over $991 million and tracks the MSCI US IMI Real Estate 2525 Index. This Fidelity ETF includes a range of large, mid, and small cap REITs. Its cap-weighted structure means larger REITs have more influence and performance, while its 150-plus holdings provide broad diversification across sectors like telecom, industrial, and retail. This mix makes FREL a strong choice for those of you looking for a well-managed, diversified real estate fund. And you should also consider iShares Mortgage Real Estate Cap ETF, REM. REM is an MREIT ETF that tracks the FTSE NewREIT All Mortgage Cap Index, which reflects the broad performance of mortgage REITs trading on major U.S. exchanges. The ETFs hold REITs invested in both commercial and residential mortgage-backed securities, so it's a good choice if you're seeking broad exposure to real estate finance. As REM includes fixed income securities, it could perform well in the current declining interest rate environment. Annaly Capital Management, the fund's top holding, represents over 15% of its assets, while REM's expense ratio, 0.48%, is larger than other funds you may be familiar with. The expense is offset by the ETF's huge dividend yield. The trailing 12-month yield is 9.2%. And you can also invest in REITs through your retirement accounts like an IRA or a 401k. This is a great way to take advantage of the tax benefits these accounts offer while earning passive income. So there you have it. Investing in REITs can be an incredible way to earn passive income, diversify your portfolio, and tap into the real estate market without all of the hassle. Whether you go for equity REITs, mortgage REITs, or a hybrid, there's an option out there for every investor. I want to hear from you, so share your thoughts in the comments. If you enjoyed this video and want to see more investing tips, make sure to hit the like button, subscribe, and turn on notification so you don't miss my next video. And as always, stay financially savvy. See you in the next video.